So we've introduced the government type activities and the related funds. Basically, all the government activities are recorded in the governmental fund, including the general government, the general fund, capital project fund, right? The debt service fund. And we mainly talk about those funds. Of course, we have special revenues, we have permanent. Now let's talk about business type activities and the related fund. So why do government and non-profit organizations engage in business activities? Right? Many reasons: to provide resources, to support their missions, subsidize the activities. Well, basically, they also want to make money so they can use the money to do for their main mission. Right? So first, proprietary funds. Proprietary funds report government's business type activities. So which provides goods and services to paying customers on an exchange basis. Okay, so revenues from these will be exchange revenues, right? There are two types of funds we're going to talk about for proprietary funds. One is enterprise funds. The other is internal service fund. For enterprise funds, basically they're doing business with external parties. Okay? Provide services to the general public. For example, City of Houston's airports, the Bush, Hobby, and Arlington Field are operated by the City of Houston, and the George Brown Convention Center, and also the combined utility systems. All these are operated in the enterprise funds. We also have internal service funds, which provides service to other government. So it's the business is done within government. For example, City of Houston's health benefit and long-term disability funds, right, basically provide services to or other government employees. Most of these services predominantly benefit governmental units rather than the general public or businesses. We're talking about internal service funds, okay? Internal service funds. Accounting for proprietary funds. Proprietary funds are said to be non-expendable or revolving. In other words, they have to balance by themselves. They have to make money to balance by themselves. And measurement focus is all economic resources, right? So we're going to adopt a full accrual basis. Budgeting is not typically required in accounting. Not typically, but you may. Financial statement will be a little bit different from the governmental funds. That we have statement of net position, right, which records assets, liability, and net position. A net position is displayed in three components. One, we have the net investment in capital assets. this equals the net capital assets, which is the capital assets less accumulated depreciation and less the remaining debt used in capital outlay. Okay, this reports a net investment in capital assets. Next, we report the restricted net position. Okay, those fund balances are restricted net position. And finally, we have the unrestricted net position. So basically, we're going to report three components in its net position. If we have restricted assets, it will be segregated, okay, and reported. For example, the restricted cash account will be separated from cash account, and the restricted cash will be reported as part of the investment. But it's reported separately, okay. Then we have the statement of revenues, expenses, and changes in fund net position, similar to the income statement. Right, similar to income statement. And also we need to have the reconciliation. Have to reconcile the beginning and ending net assets, okay, to show the change. Right, there we have the operating revenue expenses plus non-operating revenue expenses, right? And plus or minus any capital contribution, and other changes in net positions. So it's going to give us increase or decrease in net positions plus the beginning equals ending, right? Ending net position. So basically, if you look at the revenue expenses and change in fund net position, we have basically four components. We have the operating, non-operating. We also have capital contribution. Basically, these are the transferring, right? Transferring capital and other changes in net positions. And we're going to see these components pretty soon. Okay? And this is something new. Now we have to also report the statement of cash flows for proprietary funds. So the cash flow statement is prepared in conformity with GASB standards, okay, rather than FASB standards. Okay, so don't get confused. This is under the GASB standards, so will be a little bit different. So first, coverage. The statement of cash flows for proprietary funds include cash and cash equivalents. Okay, so we're going to show the change in cash and cash equivalents. And we have to report four activities rather than three activities, because FASB, right? We learned financial accounting, and the FASB we have to report three activities. We have operating, investing, and financing. But under GASB, we have four activities. We have cash flow from operating. We have cash flow from non-capital financing. Cash flow from capital-related financing. And then cash flow from investing activities. Cash flow from operating activities are the items are very similar to financial accounting. Basically, it's their main operations: cash inflow and outflows, right? And also cash flow from investing activities are very similar. Purchase investment and proceeds from sales investment. And these two are new, pretty new. They separate financing into two: non-capital financing and capital-related financing. Capital-related financing, basically, right? If we borrow money, right? Issue debt, issue bond. Those are capital-related financing. And non-capital-related financing refers to grants, right? Grants from other governments and transfers from other funds. And also the interest is recorded in differently. Remember, if we're talking about FASB cash flow statement, interest paid and received are part of the operating activity, right? Here, interest paid is recorded as a financing activity. It could be either capital or non-capital financing, depending on the debt we are talking about. But most likely it's going to be a capital-related financing activities. Capital-related financing activity. And interest received will be reported as investing activities. Okay, so this interest is very unique. Another different part is this financial cash flow statement must be reported with direct method. Okay, direct method must. Of course, after you have to do the indirect method as a reconciliation, but the FASB basically, and in FASB we have an option to choose, right? And most company will use an indirect method, which they start with the net income, and they're gonna from net income they're gonna report or those cash flow, right? And direct method is just directly started from the cash flows. Enterprise funds. Enterprise funds accounts for services are provided to the general public or a user charge basis, or whether the governing body has determined that the periodic determination of revenues earned, expenses incurred, and or net income is appropriate. So this tells us when we should use enterprise funds. Okay, basically it's if you provide a service, okay, to the general public on a user charge basis, if we need to charge money, or whenever it's appropriate. So for sure the utility, right, provided by the city will be recorded in enterprise funds. Right. Enterprise funds are required, okay, required if any of the following three criteria are met, any of them. The activity is financed solely with revenue debt as opposed to general obligation debt. And revenue debt means debt secured only by the activity's net revenues. Okay, so we have to show creditors clearly how we're going to pay them. So we need our enterprise funds to record those charges as our revenues, right? Or the laws or regulations require activities to recover costs of providing services with fees or charges. Okay, so we need to record those fees and charges, or pricing intended to recover cost. Anyway, if cost charges or the costs are important to us, we're going to use enterprise funds to record our activities when we provide service to the public on a user charge basis. The criteria should be applied to an entity's principal source of revenues. The principal source of revenues. So for a government agency, it may have multiple sources of revenues, right? But only a small portion are from the user charges. Okay, then we do not use enterprise funds, right? For example, in the general fund, we can also record fees and charges, because that's not the principal source of revenue. The principal source of revenue is tax, right? But for municipal utility, water, electricity, right? Their main source of revenue is user charges. Then we will use enterprise funds for those entities. Common types of enterprise funds: water and sewer, right? Gas, transportations, airport, toll roads, parking garage. Parking garage is a big business. If you've seen their Houston's, right? But financial reports, we have seen a lot of parking garage assets. Golf course, landfills, hospitals, liquor stores, lotteries, all these are commonly used enterprise funds. Right? For example, the City of Houston reports the following major enterprise funds. They have other non-major enterprise funds. Major enterprise funds include Airport System Fund, Convention Entertainment Facility Fund, and the Combined Utility System Fund. These are the three major enterprise funds in Houston. Now let's talk about the change in net position for enterprise funds. We start with operating revenues. These are the charges for services, okay, basically, are from the exchange transactions associated with the principal activity of the fund. Then we're going to have non-operating revenues. These are, for example, subsidies and investment earnings. Right? These are they're not main operation. And also, they are from the non-exchange transactions or ancillary activities. All these will be reported as non-operating revenues. Third component will be capital contribution. Okay, if the assets transferred are capital assets. And also in enterprise funds, we need to record restricted assets. Government should report their restricted enterprise fund assets apart from unrestricted assets. And if we have any offsetting net positions resulting from the restricted assets, okay, we end up with net positions, and this will also be reported in the restricted net position, a separate equity account. So what are so-called restricted or restrictions? And here the restrictions means we have restrictions from outside parties like debt holders or through internal legislations, okay, very formal restrictions. Resources that are merely designated for intended use are not restricted in this sense for enterprise fund, okay? So be careful, this definition is a little bit different from the restrictions for the general fund, okay? A little bit different. And restricted assets that are offset by liabilities do not affect restricted net positions. For example, we issue a bond and receive cash for restricted purposes. So the cash will be a restricted asset, right? But because this cash is from the bond issuance, it will be offset by the liability, bond payables. So it will not affect the restricted net position because it's totally offset by the liability account. So that's the example for enterprise fund. A government issued 10 million in revenue bond that are restricted to the construction of plant and equipment. So journal entry to record: the debit cash restrict for construction, credit revenue bonds payables. Remember, this is under full accrual basis. So all the journal entries are very familiar, right? And this restricted cash is offset by a liability. Therefore, there's no need to reclassify a portion of unrestricted net position as restricted. Now, in another example, the government set aside additional $2 million cash to pay interest on the debt. Okay, this is through their legislation. Now we need to reclassify cash to cash restricted for debt service. Okay, and because we reclassify this asset accordingly, we also need to reclassify the net position. Okay, so the net position, we're going to reduce net position unrestricted, increase net position restricted. The statement of net position. Municipal solid waste landfills. What are the accounting? This is accounted for either in governmental or enterprise fund. Okay, if it's recorded in the governmental fund, no liability will be recorded. Okay, and the expenditure is recorded on a pay-as-you-go basis. If we pay money, right, that's an expense, and we do not record any liabilities. If usage fees are charged, remember, if we charge usage fees and we will tend to recover the cost, then we must use enterprise fund. So these activities will be accounted for in enterprise fund. And if we use enterprise funds, then we need to consider liabilities. right? And also, if we use enterprise funds, fees must cover all costs. All costs. Not only costs incurred before, during, but also costs incurred after landfill has been closed. Landfill, when it's full, it will be closed for 20 years or even longer. Right? But still, we need to monitor the whole process. Still need to spend money. There are expenditures. So the cost, the fee we charges to a resident should cover all costs. Okay, including future costs. Future costs. So we're talking about closure and post-closure costs. So let's see this example. A government opens a landfill and it elects the enterprise fund to do the accounting. And it estimates the total capacity will be 4.5 million cubic feet and the site will be used for 30 years. And that total closure cost will be $18 million. Okay, in year one, 90,000 cubic feet were used and the related landfill expense and liabilities were 360,720. In year two, right, 120 cubic feet were used. And an updated total closure cost now. Closure cost increased from 18 million to 18 million and $36,000. Increased a little bit. Okay, so the question is, what are the related landfill expense and liability for year two? So the amount of liability we need and also expense will be calculated with this formula. Basically, this is a relative capacity used in this year, right? Multiplied by the total costs, by the total closure costs, less the amount recognized in the past year. So the relative amount has used. The relative amount used, right, accumulated will be 90,000 cubic feet used last year plus 120 cubic feet used this year. Up to today we have used 210,000 cubic feet and divided by the total cubic feet multiplied by the most recent updated total closure costs and less the liability recognized in the last year. So based on this formula, we need to recognize new liability, $960 liabilities for year two, and the total liability will be this one plus the last year's liabilities. The journal entry very straightforward. Once we accrue these liabilities, we debit landfill expense and credit liability for landfill costs. And by doing this, when this landfill is closed, we should have approximate, right, 18 or even larger $1 million liabilities. And then any closure and post-closure spending, including capital outlays, will be a reduction of the liability for landfill costs. If we purchase a vehicle For that purpose, right, we no longer recognize an asset, although it's a full accrual basis. And if we purchase a vehicle, that's going to be, we're going to debit liability for landfill costs, right, and the credit cash, right? That's it. Pollution remediation costs. Government can be held accountable for pollution cleanup costs owing to a variety of circumstances. Right, for example, school district discovered mold and toxic substances. All these will be covered by the government. And in recent weeks, right, water fire and air pollutions, debris, all these will be covered by the government, right? As with landfill costs, pollution remediation costs may be accounted in either governmental or enterprise funds. Okay, and we know if we use enterprise funds, we're going to charge, right? We're going to charge users. So if we use government fund, only current outlays would be recognized as expenditures, and we know that. So if we spend money current period, that's going to be expenditures, and then no long-term liabilities will be accrued. And if we use enterprise funds, and also if we report in the government-wide statement, right, estimates of costs will be incurred in the future will be reported as both expense and offsetting liabilities. So in other words, the future cost will be accrued and reported in today's statement. Now, internal service funds is another type of proprietary fund. Internal service funds are an accounting device used to basically accumulate and allocate costs internally among the government's entities, various department units or functions. So a lot of times government departments, they're going to do transactions, and usually it will be recorded in general service funds. Well, the purpose is not to earn profit, but the purpose is to provide a service. Is to provide a service to other unit, right? So revenues typically will equal expense in internal service fund. So they're going to charge, but enough to cover the cost, and that's it. The primary reason is to gain efficiency, okay, in government's operations. Examples we have is central purchasing, storage, insurance of supplies, maintenance, and janitorial services. Again, it's a proprietary fund, so we're going to use a full accrual basis. Revenues derived mainly from other governmental or proprietary fund. Capital assets acquired by contributions or grant must be depreciated. And revenues and expenses are closed at year end. What's unique here is when we do the consolidation, putting all the funds together, there are duplications of revenues and expenses, receivables and payables. For example, if government unit A, right, provides service to government unit B, and government unit A will record revenues, and an expense, right? And governing unit B is also going to report an expense. So we have two expenses for the same service. Okay, obviously there's a duplication, right? So this will be eliminated. The same thing applies to receivables and payables, right? So for the same amount of money, part A will be receivables, part B will be payables. But if we consolidate all the units together, these two will offset with each other, right? Offset with each other. So we're going to do all these work when we have the government-wide financial statement. When we put all the funds together, okay, we're going to eliminate those duplication. Self-insurance. Some governments elect to self-insure their risks. Right, the purpose is to reduce premiums. But is that a true insurance? Right? You can sell insurance to your agents, to your own agency, but that's not actually an insurance, because you do not transfer the risk to outsiders. You retain the risk insiders. Basically, it simply sets aside funds to provide for possible losses based on actuarial determined amount. It's just a provision or allowance account, basically. We can either use a general fund or the internal service fund to account for these activities. Okay, self-insurance under internal service fund. For internal service fund, we recognize revenues for the full amount of the premiums billed if the premiums satisfy one of the following. Well, the total charge covers the actual losses incurred by the fund. The total charge is based on an actuarial method or historical cost method and is adjusted over time so that internal service fund revenues and expenses are approximately equal. Basically, as long as our premiums are not super outraged, the premiums should be enough to cover the possible loss. Okay, if the premiums are enough to cover the possible loss, then we may record them as revenues, and these revenues eventually will offset the expense. If the actual premiums are higher than the above criteria, the extra premiums billed are recorded as non-reciprocal transfer to internal service fund. Okay? It becomes a transfer. The extra part will be recorded as a transfer. If the actual premiums are less, the deficit will be charged back to the insured fund. Okay? They're going to send another bill to charge more. Self-insurance under general fund. The amount of premium revenues recognized should be limited to the actual claims expenditures. Actual claims expenditures. Remember, for general fund, it's government fund, right? We only record the current resources, the actual payment, and actual receipt. So the expenditures will be recorded, or revenues will be recorded when we have the related expenditures. Okay. Revenues will be recorded when we have the expenditure, the claim expenditure. If the actual premiums are higher than the actual claim expenditures, then the extra premiums are recorded as non-reciprocal transfer to general fund. The purpose will be the same, right? The total revenue equals the total expenditure. Here, the total revenues equals the total expense, right? Service concession arrangement. Service concession arrangement, SCA, are long-term arrangements in which a government contracts with private sector entities to operate in major capital assets. For example, the toll roads, right? Hospitals, student housing, airports, etc. The government can contract with a company, outside company, to operate its toll roads. The government will transfer to the contracted party the right and related obligation to provide services through the use of infrastructure or other public assets. In exchange, the government receives from the other party an upfront payment and a series of payments over time. Right? Any gains from the transfer of the asset will be deferred, recognized over time of the contract. Right? For example, the government receives a upfront payment, right, $100 million, to transfer the right of the tollway to a company. Right? This is $100 million. Will not be booked as revenue. It will be basically deferred. For example, they signed a contract for 20 years, so the $100 million will be deferred and amortized in 20 years. In a sense, these arrangements are equivalent to borrowing transactions. So we finished the proprietary fund. Now we move to fiduciary fund. Okay, fiduciary fund. Fiduciary funds are maintained to account for assets that a government holds in a capacity of the fiduciary. Or in other words, this is the government merely holds those assets for somebody else. Okay? The government controls resources for the benefit of parties other than the government itself. Okay? So these resources are going to benefit parties other than the government itself. To somebody else. Okay? It's not to the public. The governments will hold assets in a trust so that these assets are legally protected from the claims of the government's creditors. The government is acting as a trustee for a beneficiary. Remember, the beneficiary is not government itself, it's not public, it's other people. It cannot determine who should be the beneficiary of the resources, or to what purpose the resources must be put. Right? Because the government is merely a holder of those assets. Okay? For example, if a donor contributed resources to the university and asked the university to select scholarship receipt, in this case, university will consider the resources to be its own, then record them in governmental fund, right? We have seen that. Not in a trust fund. Alternatively, if the contributed resources benefit the government's activities, so it will be, for example, it benefit the government's operating a park, right? Help government operate a park. Then it is a governmental fund, which is known as permanent fund. Okay, we talk about permanent fund. Basically, permanent fund is a fund that's going to benefit the government itself. And usually we cannot use the principal, only the interest and the earned interest and value increase can be used for the government's activities. So in these two cases, okay, they are not fiduciary funds. Okay, so what is fiduciary fund? Example. The fiduciary fund example is a donor contributed resource to the university, and the donor is going to select or recommend the receipt of the scholarship. Okay, in this case, the university is just a trustee for the donor. Okay, the university cannot determine who should be the beneficiary of the resources. Therefore, this donation will be recorded in the fiduciary fund, in this university. Fiduciary funds. General rules for recordings. Fiduciary funds account for both non-expendable and expendable resources. The focus will be economic resources, right, for accrual basis. This is the same with the proprietary fund. Also, reports are similar to those of proprietary funds, but okay, one key difference is fiduciary funds are excluded from the government-wide statement, because the government-wide statement reports all their activities, right, resources, right, held by the government. But fiduciary funds, okay, government are just a trustee. Okay, they are not the owner of those funds. They do not belong to the government, so they will be excluded from the government-wide statement. This is a very important difference between the fiduciary funds and the proprietary funds. So how to record? We use additions to record revenues and deductions to record expenses. This is different from the proprietary fund. And also, we do not report cash flow statement. Okay, this is also different from the proprietary fund. Otherwise, other things will be very similar. There are 4 types of fiduciary funds: with pension and other employee benefit, OPB, trust fund, investment trust fund, private purpose trust funds, and custodial funds. Let's take a look at these quickly. Pension. Pension is a sum of money paid to retired or disabled employees based on their years of employment, based on their service. There are 2 types of pension. We have defined contribution plan, right? So basically, every month, right, employer is going to contribute basically to this plan. So for defined contribution plan, very similar to the 401k plan, right? We're going to report expense for the amount contributed. That's very straightforward. No pension related liability on balance sheet. Another type of pension is defined benefit plan. This is a little bit more complex. Under this plan, we're going to use actuarial cost method to allocate the total cost of expected benefit over the total years of employee service. Okay, so basic idea is we're gonna allocate a total estimate actually, right? The total cost of expected benefit, right? Until the employee pass away. We can allocate a total cost over the total years of employee service. It's not an easy job, and because of that, we're going to report a pension liability on the balance sheet. Okay, so we're going to focus on defined benefit. Defined contribution plan is a pay-as-you-go plan, basically. So how to report pension? Well, let's talk about how pensions are reported. In a government-wide statement, okay, we're going to follow the a full accrual basis. So if we follow a full accrual basis, we need to report the total pension liability, which we just mentioned, right? The total pension liability is a total future cost, right? We estimated using the actuarial method, which will be quite large. So how do we report? Amount reported as pension or OPEB liability in a financial statement depends on whether it has a trust for its pension or OPEB plan. And this trust must have the following characteristics. Employee contribution to the trust are irrevocable. Plan assets are dedicated to providing pension or OPEB benefits, and plan assets are legally protected. So if we have those trusts, okay, then we're going to report pension liability as the difference between the total pension liability and the net pension and net plan position. Because for those trusts, we're gonna put money into the trust. Of course, it will incur some liabilities, but we're gonna have a net plan positions. So the difference between the total pension liability and net plan positions is the net pension liability. This is the amount we owe to our employee. Net pension liability. So as we said, total pension liability is actuarial determination, okay, of the present value of the benefits attributable to plan members' past services. Okay, so as a member increase their service years, this liability will grow. Also, this liability is affected by other things, like the interest rate, right, and also return rate, the estimated age, those kind of things. The net plan position is the total assets in the pension plan less any pension plan liabilities. So we have a net position in the trust fund. Therefore, the net pension liability equals total pension liability less the net pension, a net position of the pension plan. Okay, for example, this is a journal entry we typically to record for pension-related activities. As you can see, when the pension, the total liability grows, right? So will expense. So for example, for this period, the total liabilities based on actuarial calculation, increased by 150. Okay, among which we contributed $100 cash. We put $100 into the trust fund, pension fund. Okay, so there's a $50 shortage. Okay, and the difference become the increase in the net pension liability. Okay. Of course, we have other transactions, but they're not major ones. So give you some idea what's going to happen if we have a net pension liability. The larger the net pension liability here, as you can see, the more likely that this plan, the pension is underfunded, right? Underfunded. If we fund every dollar that we own to our employee, right, we should not have the net pension liability, because the net position in our pension fund should have enough money to pay for all their total pension liability. There's no net pension liability will be recognized. Okay, other accounting issues for pension trust fund. So when we contribute to pension plan, we're going to credit additions, pension contributions, right? This is equivalent to revenues, and debit due from general fund. And when we pay benefit, we're going to debit deductions equivalent to expenses. Debit deductions, retirement benefit, credit cash. And if we have interest incomes in the plan, we're going to accrue those incomes. Debit interest receivables, credit additions, interest. Right? If we purchase equipment, we debit equipment and credit cash. And once we have the equipment, we're going to record a depreciation. Okay, so these are easy to follow. So the main assets, let's talk about a pension plan. Okay, pension plan, the trust fund. The main assets of pension plan are its investment. And the plan assets should be reported at fair value, right? Remember, we've talked about investment, equity, and all the debt investment will be reported at fair value, fair value. Receivables are usually short-term and it consists of contributions due from employees and other entities. Okay, and the main liabilities are benefits currently due and payable. Okay, benefits are due and payable, and investment and administration fees not yet paid. As you can see, in the pension trust fund, we only recognize current liabilities. Okay, current liabilities, benefits currently due and payables, and investment administration fees due and payables. But these are not benefit related for the investment administration fee. So we do not record the actuarial liability, total liability in the pension trust fund. Okay, so if you read the pension trust fund, we cannot figure out what is a total pension liabilities. We don't know that. We have to go to the government-wide statement to see that information. At fund level, we don't have the total pension liability. What we do have here is the net position, right? The assets less the liability is the net position of this fund, of this pension fund. And this position is restricted for pensions. So the statement changing fiduciary net positions, because we have additions, right? Which includes investment incomes and contributions, and also we have deductions, which is the benefits payment to retirees. So basically, that's a component of the statement change in fiduciary net position. Types of disclosures. GASB requires extensive disclosure on the financial statement on both employer and plan. So what should be disclosed? Description of the plan. Right? All the details will be disclosed about pension plan. And also information about net position liability, assumptions, right? Alternative measurement, net pension liabilities, calculated using discount rate 1% or higher or 1% lower than was actually used. Particular as to pension plans, assets, liabilities, deferred inflows and outflow resources, and all the details as to changes in total and net pension liabilities. So as you can see, it's a lot of details. A lot of details will be disclosed. And also disclosures required as required supplementary information, RSI, which is part of the comprehensive financial statement for GASB. So in RSI, we're going to disclose the change in total and net pension liabilities. Okay, net position liabilities as percentage of covered employee payroll. Which is, we know that net pension liability. Net pension liability is basically the unfunded, unfunded pension. So we have to keep an eye on this. If it's too large, then something wrong with the pension plan. Then we can also need to disclose the actually determined contributions if calculated. Post-employment benefits are very similar to pensions. Okay, they're also part of the compensation provided to employees in exchange for services provided. Right here we have a disclosure for City of Houston for the post-retirement health insurance benefits. Okay, you can basically see again a lot of details are disclosed. What we can see here is obviously we can see the net, right? The net OPB obligation. And this shows how the net OPB obligation changes. So investment trust fund is also a fiduciary fund. Investment trust fund is used to account for and report investment pools in which the assets are held in trust for the benefits of others. Okay. So again, if the government have investment trust fund, okay, they're going to benefit of others. Okay, not government itself. So they will be operated like mutual funds. The governments are permitted to invest temporarily available cash in these pools and thereby earn a return on their assets without having to incur significant cost and the risks. And private purpose trust fund. These are trust that is neither pension nor investment. They can take many forms, like endowment held in trust to benefit needy employees or their families, or a university scholarship trust fund, right, in which the assets were received from donors and they are disbursed to student beneficiaries in accordance with terms of the trust agreement. And the university has no administrative controls or direct involvement with assets. So basically, the money belongs to does not belong to the government, university, right? University is just a trustee. So these are the private purpose trust fund. So alternatively, if the beneficial parties are the government or the general public, then it will be a permanent fund, right? Custodial fund. Custodial fund account for assets held by a government unit acting as an agent for one or more other government unit, individuals, or private organizations. This is also known as agency fund, right? For example, we have tax agency fund, pass-through funds. For example, tax agency fund, right? The government is just collecting tax on behalf of another government. Okay, so they just provide a bank account and collect the tax and void the tax to another government. Or the pass-through funds, which they have totally no administrative role. They not get involved in those pass-through funds. So to report custody funds, okay, there's no net positions. There's only two things: assets and liabilities. Since it is held on behalf of another party, all the assets equals liabilities. All the assets are someone else's assets, right? Okay, this is pretty much for this lecture, and see you next time.